All right. Good morning, good afternoon, traders. Today is Wednesday, August 6th, 2025. This is You've Got Options for Income Navigator. And today we're going to talk about iron condors. We're specifically going to look at a trade that I put on yesterday. This is the only trade that we currently have on. We previously closed out two other iron condors. And if you wanted to see what those trades were, you can go to Discord and in the search box under trade alerts, you can just type in iron condor and you will see that those trades were trades 3202, This is trade 3219 that we have currently open. This is 1 day in the trade. You can see the underlying has already moved zero point 0.9 standard deviation. So we saw a pretty decent move higher from yesterday's levels. This trade is kind of, break even, maybe down a little bit. And as you could probably see, when I entered this trade and I had a couple of questions, my goal was to set up an iron condor that is made of two credit spreads, right? We have a put credit spread and we have a call credit spread. And I'm looking for the widths of these spreads to be equal. They're 50 points each. So 50-point put credit spread, 50-point wide call credit spread. And I also wanted to make these credit spreads about equal in the amount of credit, right? So if I was collecting, let's say, $7.50 for the call credit spread, I also wanted to find a 50-point wide put credit spread that pays about $7.50. In this case, my total credit was 1460, so I collected just a little bit over $7 and maybe $7.30 from each side. And the way the market is set up right now, you can see that the same credit available on the call side is a little bit farther out of the money, right? Which, if relative to the distance of the put credit spread, meaning that puts are relatively cheaper than the calls are right now. So maybe the market is anticipating some kind of a rally. I'm not sure exactly why, but the skew right now is to the upside. There's a little bit more premium available to the upside. So now you can see we have a little bit more room to the upside. And as always, we start off with iron condors that are balanced with slight negative delta. Now, one question I got yesterday was, when do I choose to put on iron condor versus doing something like a OG bear trap, where OG bear trap is it's more of an unbalanced put condor. So it's not an iron condor, it's a put condor, and it would look something like this, where you have most, if not all, of your risk is on one side. Let me just change, right? So this is what an OG bear trap would look like, with the price being, it could be outside of the structure, it could be inside of the structure. But as you can see, the risk drastically shifted to the downside. There's very little risk to the upside. And if we move the long leg a little bit closer at the money, you can see we can potentially remove all of the upside risk. And as you can see, the delta of a structure that is drastically unbalanced, right, is quite different. And the starting delta is positive in this trade. So I guess this is a very individual decision that you need to make, right? What is your near-term price outlook? If you're bullish, and you can look at the chart, and if that's what you use to decide, whether you're leaning bullish, bearish, or neutral right now, right? Looking at the chart, you can decide: do you want to add a trade that is delta neutral? Do you want to add a trade that is delta positive, or do you want to go with a balanced iron condor that will start you off with a negative delta exposure? So there is no right and wrong, and I'm going to continue to beat this drum because I don't think there is the only one right way or right trade or right strategy, and everything else is wrong. You can you can trade the same thing I'm trading. You just set up your trade slightly different, tweak it a little bit to where it works with other trades that you may have going on at the same time, right? The way I look at trading is that, we're all trying to put pieces of a puzzle together. I don't know what your puzzle is going to look like in the end, right? You do. So depending on where you're trying to get to, you need to figure out what kind of pieces you need to put together in order to put together the puzzle that you're building. So if you need, positive delta, then you want to go unbalanced to the upside. If you need delta neutral trade, right, you can go with something that looks like this, right, where you don't have a whole ton of positive delta. You're, maybe you go a little bit higher on, and now you have a, delta point oh 0.01. So this is a really neutral trade. You may have risk on the upside and on the downside. You don't have immediate risk. And, maybe you want to wait a week or two and you can see, maybe going 14 days out. If you're right on the neutrality of the market direction in the near term, in the 2 weeks, if we don't see a pretty big move, that exceeds about 1.5, maybe 2% up or down, right? You may be able to get out of this trade with maybe a small profit. So if this trade was put on for about a $1,200 credit, in 2 weeks, if you can grab first $200, right? What's 200 out of 1,200? 200 divided by 1,200 is about 16% of max potential profit in the first 2 weeks. I think that's a great trade to take, and just keep it moving, right? Even though you may say, well, why would I want to do that? Because this is a super, not super high, but it's a fairly high probability trade setup. And I agree, but the longer you wait, right, the longer you stay in the trade, yes, you have a potential to make even more. But the longer you stay, market isn't always going to trade inside of 1% range, right, from where we start this trade. The longer you stay in the trade, the more risk of market moving outside of this 1% range. And if that is the case, right, you could end up with, a market move something like a 2.5% in 30 days. And as you can see now, your delta will start to change. You get to a point where you're accumulating negative delta, and while you're holding on longer, you're not really making any more money because now you are exposed directionally. And the longer you hold and the higher the market moves, there is a point where you might give up all of your unrealized profits, and I think that's just a function of being a little bit too greedy. I feel like these kind of iron condors aren't meant to be held until expiration, unless you are willing to accept the chance of the market making a big move up or down, and you may go through some kind of a drawdown, and then eventually you will capture the price inside of this profit zone. I think the path of least resistance with these kind of trades is, figure out what you're looking to make, right, as far as percent of max profit, and be realistic. 50%, it's great. We hear a lot about that, right? Get 50% of max credit available and get out. But here, if you were to put on this trade for you to get to 50%, which will be about $600 profit, because we're not trading naked, or we're not selling strangles, right? Because we have the long wings, where the decay, right, and any volatility crush that we get from these short legs, they get offset by the long legs, even though they're 50 points away. So it will take a while. You will have to be committed. You will have to wait for quite a bit of time to get to that 50%. So just based on, this software here, to get to 50%, right? So if the credit for this trade is going for about $1,200, to get to $600 profit, right? You would have to be in the trade for about 34 days or so, right? And then the price, the price has to land. Hang on one second. Let me, right, you can see where 600 is. So the price has to be somewhere inside, right, this 63.50 and maybe 64.50. So somewhere inside of this range in order to get to that 600. The odds of price being inside of this small 100 point range 34 days out, I mean, I can't tell you, but it's not a very high probability. We may be outside to the upside or to the downside. So if you catch it here, great. But if that's your game, I don't think it makes a lot of sense in the long run, right? Unless you trade very, very small, where you could put on a bunch of these trades and spread them out. Some will be inside of this box, some will be slightly outside of this box, both up and down, but you will average in, that $600. But if you're only going to, deploy two trades a month or something like that, I think there are other ways trying to get to more realistic profit targets. And in my opinion, setting up something like a 20% of max profit as your first target would be a great target to achieve. I don't think it's very hard to do so. Then maybe 30%, maybe 40%. And I think anything beyond 40%, you're now going to actually stay in the trade longer. And I don't think you're reaping any more benefit by being in the trade any longer. So I think anything beyond 40% of max profit, your return or your rate of return is going to start to diminish. I could be wrong. There's been a ton of studies that were done, looking at trades and at different points in time, looking at different configurations, different setups for an ion condor, balanced, unbalanced, skinny, wide, super wide, different durations, and so on and so forth. And looking at how fast we get to 20%, how fast we get to 30%, 40%, and so on. And I think that the conclusion was, if you do something between 45 and 56 or 60 days until expiration, and you hold beyond 40% of max profit, your return, if you look at your P&L per day, right, in the end, your P&L per day will start to drop off. And that's not what we're trying to do, right? We want to try to maximize and or deploy our capital as efficient as possible. So let's just go back to the trade that I put on. And again, the setup for this trade was, and I'm going to try to take some or write some notes for you guys. Hopefully you can see this. Give me one second. There it is. So hopefully you can see this. Let me know if you can. If you can't, we'll figure out something else. But um, can you see this white box? I'm going to type some notes in here. Okay, perfect. So the setup, right? We are looking for a 50-point wide credit spreads, right? Because we have two put and call credit spreads, 50 wide credit spreads for a total credit of about $15 or 15 points. Right, 15 points times 100 is $1,500 credit. Okay, so now our max profit is the $1,500 that we're looking to collect up front. Our margin for this trade is 50, which is the width of these spreads, minus 15, which is the credit that we're collecting. We're left with 35 points times 100 equals $3,500. So if you say to me, hey, can I do this in a $5,000 account? The answer is yes, right? Even though a $3,500 margin in a $5,000 account, you will be using more than 50% of your capital. And if you're okay with it, I'm not saying this is right or this is wrong. I'm just saying that can this trade be done in a $5,000 account? Yes. Will you have a ton of room to do other trades? No. And if you only have a $5,000 account, I think you want to start with one trade and just stick to one until you become a master of this trade. And then as your capital grows, as your experience is going to grow and your confidence is going to grow, you're going to have more capital, more experience and confidence to put on, more than one trades. Maybe it's, two iron condors that are going to run side by side, or maybe you go from, iron condors to calendars or to something else. But the idea here is what your max potential loss is. This is absolute loss. This is not a planned loss. This is how much your broker will ask you to put up if you wanted to put on a one lot of a 50 wide iron condor collecting a $15 credit. And let's talk about what is a return on this margin, right? So if we go to make $15, 15 divided by 35, 15 divided by 35. If we are going to capture the full $15 credit that we're collecting up front, meaning if we hold until expiration and both credit spreads expire worthless, we'll keep the $15. That $15 profit on a 35-point margin will be equal to about 42.85%, which sounds great. And there are plenty of gurus that will sell you, these kind of, super hyped up numbers. One trade makes 40% in 30 days, follow me, blah, blah, blah. But I think it's nothing more than just a bunch of nonsense, right? This is the best case scenario. Yes, we could expect the price to be inside of the break evens, and we'll talk about, how do we get to break evens. Inside of break evens, we could expect the price to be inside of break evens about 65% of the time. So yes, you are getting a more than 50% probability that you're going to make the $15 credit. Okay. But it's not a 100% probability. There are going to be times, the other 35% of the time, you're going to be somewhere outside of the break evens. And as you can see, we're risking 35 points to make 15. Our risk reward is not skewed in our favor, right? So we have good odds. We have more than 50-50 odds, but our risk reward is also not 50-50. It's slightly skewed in or against us, right? And if you want to do the numbers, it's going to kind of work out to be a zero sum game, right? If you say, if I'm going to win 6.5% of it, or six and a half times out of 10, I'm going to make 15, right? And then 3.5 times out of 10, I'm going to lose 35. What am I going to end up with in the end? Right? So the what we're going to try to do here is say, all right, 42% sounds like a great deal, but this is not what we are trying to do. What we are trying to do is we're going to identify some profit targets. I think what makes sense, or before we go into profit target, let's talk about, we know what our max reward is, which is 1,500. That's inside of this area here. Outside of this box here, our max potential loss is $3,500, and that is below 60/50. That's where the long leg of the put credit spread, and above 6,700, which is the long leg of our call credit spread. Right? This is max absolute loss. We're not planning on taking this loss. We're not planning on holding this until expiration. But if the market closes today and we don't open for 57 days, right? This trade has 55 days. If the market does not open until 57 days from now, where your trade is already expired and the price is somewhere below 60/50 or above 6,700, you know that you cannot lose more than $3,500 in this trade, right? So you may not want to take that kind of loss, right? We don't plan on taking this kind of loss, but we know beforehand that worst comes to worst, for whatever reason, if we expire somewhere outside of the structure, our loss is $3,500. So now let's talk about break evens. To calculate your break even, it's very simple. You take your credit that you're collecting up front. In this case, it's $15, and you subtract this $15 from the short strike on the put side, right? So if your put is 6,100, you go 6,100 minus 15. Your downside break even is about 6,085. And on the upside, we take the short strike off the call spread, which is 66.50, and we add the $15 credit, right? The $15 credit pushes our break even slightly farther out from the short strikes. So if the call short strike is 66.50, we add 15 to it, we end up with 6665, right? 6,665. That is the level, that is the break even level at expiration, not today, not tomorrow, at expiration. So if we're at 66.65 at expiration, we're at a break even. Anything less or anything lower, that's a profit. Anything higher than 6665, now we're starting to expect a loss. Same thing on the downside. That $15 credit gives us a little bit more room to the downside. So we take our short strike and we push it down 15 points, and that's where our break even at expiration is. Right, so anything below 60.85, that's a loss. Anything higher than 60.85, that's a profit. So technically, right, between 60.85 and 66.65, that's a profit, and we have about 64 or 65% probability of seeing a profit at expiration. So now let's talk about profit and potential loss. I think, and you don't have to agree, but I think profit target one, it's a very reasonable profit, is a 20% of credit. So how do we figure that out? If we're collecting $15 as our initial credit times 0.2, right? 15 times 0.2, we get 3. So we're trying to make $3 out of 15. So if this trade is showing a gain of $300, that's our profit target one. If you're doing multiple contracts, you can look to scale out, or you can say, all right, profit target one is hit. I think it can stay longer. Market looks like, we're consolidating. I don't expect much, blah, blah, whatever. If you find a reason to stay, you can say, all right, where is my profit target two? Well, profit target two, right? You can do 30%. Very similar, same math, right? 15 times 0.3. Right? Where you get 4.5. You get to 4.5 out of 15. That's a profit target too. Now you have to make a decision. Do you want to get out? Do you want to stay? I'm not here to tell you to get out or to stay or what. No one here is going to tell you what to do. You have to figure out, right, what works for you. Is 4.5 enough for you? If it is, get out and, you know, set up a new trade. I think in my experience, if you can get to if you can get to 20% of credit in like the first week, right? We put on this trade, let's say 55 days, 56 days, 7 days goes by. If you get to 20% in the first 7 days, you're way ahead. I think it's time to take it and move on. That's what I would do. Right? You can say, all right, you know what? I'm going to stick around a little bit longer and wait for profit target two. But then it may take, right? Just because you're way ahead and on day seven, your second target may not get hit until 30 days later. And if you look at the difference, how long it took you to get to profit target one versus how long did it take you to get to profit target two, right? You could have potentially recycled this trade and set up something else, and all you're doing is chasing the first 20% instead of waiting for the second or for an extra 10% because the difference between the first target and the second target, right? You stayed too long, and if you calculate P&L per day, you can see that you actually reduced your P&L per day waiting for the second target to hit. So I'm not saying that this works every time. I'm just making the case that if you get to profit target one in the first 7 days, I think it makes sense to take it off because it most likely the rate of your P&L per day is going to slow on the way to profit target two. And then profit target three, you can do 40%, which would be a final target for me. 40%. You get to 40% of credit. And if you could get there in about half the time, so if we set this trade up 56 days, if you can get there, maybe 25, 28 days, if you can get to 40% in 28 days, you're on track. I think this is a good time to book profits. And from there, anything beyond that, right? If the market hasn't moved in the first 28 or 30 days, sure, the second 28 days may be just as quiet, but the longer you stay, the more chances are that market is going to move. And if that does happen, right, you're probably going to give up some of the unrealized profits, and then you have to continue to hold and eventually try to capture price inside of the profit tent. So that's why I think taking 40% and just recycling, it's a lot easier to capture the first 40% than the second 60%, right? We want to avoid having to deal with short gamma, in the last, 21 days or less until expiration. So profit target three will be 40% of credit. That's 15 times 0.4 or 6 out of 15. All right, so that's kind of the idea. All right, so these are my profit targets. I'm only going to consider, right, setting up um, my stop based on my profit target one. Maybe you want to do maybe a blend of one and two, depending on, but if I'm looking to get to profit target one and get out, if I know that I'm going to make $300 in this trade, right? How much am I willing to lose? Right? I'm not willing to lose 35 points. That's why I said, even though this trade margin requirement for this trade is $3,500, I'm not looking to lose $3,500 trying to make 300 bucks, right? Because if I lose, more than if I make $300 but I lose $3,500, I will need, more than 10 winning trades just to get back to break even, and that's just a terrible business plan. Right, so $3,500 loss is never to be considered. This is just what we have to put up in order to get into this trade. In my experience, and what I think makes sense is if I'm looking to make $300, I'll be willing to risk maybe $400, maybe $450. look, I'm not going to win every single trade, right? And again, we don't want one loss to cost us, seven, eight, nine, 10 winning trades. If I'm going to make 300 and I'm willing to, lose 450 to do it, yeah, so my loss is about 1.5x my winner, right? I don't want my losses to exceed too far beyond my winning trades. As long as my win rate is going to hold up, if I'm going to win, maybe seven, eight out of 10 trades, right? If I'm going to make $300 seven and a half times, so that's 7.5 times 300, I'll make $2,250. And if I'm going to risk, let's call this $450 times 3.5, right? I will lose about $1,575. And if we back out 1575 from 2250, right, I should end up with a net profit of about $675. Right? So there is positive expectancy. We can have 40 trades in a row without any losers, right? Just because the market is not freaking out, the market is easy. We get to 20% of credit in the first 10, 15 days rather quickly without any kind of, drama in the marketplace. So we can have stretches for, you know, 20 winners in a row. Again, as long as we keep our losers to not exceed too far more than what our winners are, I think we're going to be in great shape. Right. Every now and then we may catch more than 20%. Maybe we'll get $400 and so on. But as long as we keep our losses somewhere down to about 1.5x our target one, I think this makes sense. So this is as far as targets go. Hang on one second. Let me see if I could. I don't want to erase these things just yet. I just want to highlight some of these things. All right, and then we have this is the setup. All right, let's talk about a stop. Right, so stop. We talked about the stop 1.5 times. Again, you want to understand if I'm going to make 300, how much are you willing to lose? Maybe you say, you know what, I'm going to be a little more loose with this. And instead of doing a $450 stop, maybe I'll risk 2x my winner. So if your winner is 300, maybe you're willing to risk $600. And then you can go and you can see where is that price level, right? Where you need to stop out, right? If your winner is 300, right? You're somewhere here. So you need to get to somewhere over here. Right now we're not seeing that because the curve, right, the T+0 hasn't really started to go up yet. Right? It'll take a few days, perhaps. But what about a loser? So a losing trade, if I'm willing to, let's say, risk 450, right, as my first stop loss. So it's somewhere here. Where is that? Oh, it's somewhere here, right? This is where, right, I'm just looking at the graph. Where am I down 450? Down 450 somewhere around 6,500. I'm not saying that we can't get there, right? Maybe a little bit more, 65.15 or 65 or 65.20, something like that, right? But if at any point this trade is down $450, that is not the time to start to look for adjustments. That is not the time to start to ask for opinions, and it's time to stop out. That is your stop, get out. You could always put a trade on it. Once you start to make adjustments, even though we do have quite a bit of credit here to spend on potential adjustments, Again, I think the path of least resistance, set up your trade. You're looking for just 20%, right? And if it goes against you, right, the market has to move based on today's numbers. The market still has to move another 3% higher. I'm not saying we cannot move 3% higher. We can, but it's going to take a little bit of momentum in the marketplace. And if that does happen, we can't stop the market, but we can stop this trade, right? Don't fight the market, because if the market starts to get going, we get over 6,500. Guess what? We're at all-time highs. There's very little to no supply, right? We've never been above those levels. Now everybody's chasing, right? Everybody wants to be in the market because the market's going, and you end up, continuing to convince yourself that for some reason the market should be trading lower, and this trade is going to come back, while you continue to, hold a bad trade that can go from bad to absolute worst, and that's not the game you want to play. So honor your stops. They're there for a reason. Unless you're going to plan for some kind of adjustments, then that's fine. But I think the easiest thing to do is you hit your stop, get out, and reposition, right? Pretty simple. Um, let's talk about sizing of the trade. How I would go about sizing. You can size it any way you want. I'm going to tell you what I think makes sense. And oops. And I think that there are many ways to size a trade. I would like to talk about what I do. So let's just assume, for example, and this is just an example, you can apply this to, whatever account size. And I also think that, before we talk about sizing any trades, if you're new, right, if you've never traded iron condors, if you've traded them for a little bit some years ago and then you haven't touched it, now you're trying to get back in. You haven't really done a bunch of them since. You have $1 million account and you could possibly put on 25, contracts. Just because your account size allows you to put up to 25 contracts doesn't mean that's the number that you should do. You should not do that number, right? You want to you want to learn the trade on a smaller scale. So if you're going to, screw things up, if you're going to make mistakes, if you're going to take losses because of those mistakes that you may take, you want to do it on a smaller scale. Once you master the trade, once you really know what you're doing, and you'll be able to fully understand and execute, and to find the trade, to set the trade up, to enter, to exit, to set up your profit target, to set up your stops, everything like the back of your hand. Then you have to also keep track of your performance, right? You want to find consistency. Now, you could be consistently unprofitable, which is a form of consistency, but that's not really what we're looking for. We're looking for consistent, positive results. I'm not saying that you need to have a 100% win rate. Yes, there are going to be some losers, but you want to see that, you have, number one, net profitable P&L. And this is not over 4 or 5 trades. Do it for 3 months, do it for 6 months. If you're going to do one trade every 3 months, then you need to do it for a lot longer. But if you're going to do, 2 trades a month and you do it for 6 months, that's 6 trades. Maybe do 10 trades, right? If you do 10 trades and you see that, you're getting decent results and you have a positive outcome and you're fairly consistent with your input and your output, then you can say, all right, I'm going to go from a 1 lot to maybe a 3 lot, right? You can get up to 25. That's your goal. That's where you're going, but it's not going to go from 1 straight to 25, because if you make one mistake on the level of 25 contracts, it's going to put you in a really bad place. So you kind of want to work your way up. Maybe you go from 1 contract to 3, from 3 to 5, from 5 to 7 to 10, then you go to 15, and then eventually, yes, it's going to take time, and eventually you will get to scale your business to the size that it needs to be. And I promise you that by the time, if you take small steps, by the time you get to that 25 contract size, you will have seen all sorts of different markets. You will be in all sorts of different situations where, by the time you get to 25, you'll have enough experience, and more than anything else, you are going to be used to seeing these kind of P&L swings, right? One contract P&L swing of, just a couple of $100, if you multiply that by 25 and turn it into dollars, right? Completely two different stories. So if you're comfortable seeing a two, three, $400 P&L swing, that's fine. But if you now we're talking about a $10,000 swing, it's a completely different story. If you have never seen a $10,000 P&L swing, then even though you can do 25 contracts, that's not what you need to do. You need to get used to seeing $200 P&L swings, $400 P&L swings. Then you'll see you get to $1,000 P&L swings, and it'll take time, but you will get used to it because you're not only going to see negative P&Ls, you're also going to see positive P&Ls, and it takes time. Right? Speaking from experience, it takes time to get used to seeing bigger numbers as far as P&L swings. It's nice when you have a $3,000 P&L swing in your favor, but if you're not comfortable seeing a $3,000 P&L swing against you, then maybe you're not ready to be trading on that level just yet. So you need to continue to stay on whatever level you're comfortable until you are confident enough and comfortable enough to increase size and potentially deal with higher P&L swings. So let's just, do something very simple where we're going to use account size 100,000. Max allowable loss. Let's say, and again, people say that, it's 2%, 2% of 100,000 is 2 grand. If you have never seen or you're not comfortable with taking the $2,000 loss and be willing to move on to the next trade, then 2% is just the wrong number for you to use. Don't use a number just because somebody on the internet said so. What is the dollar amount? Maybe you're only willing to lose $500 initially. $500, that's what you're willing to part with if everything goes wrong and you need to stop yourself out. Don't start taking $2,000 losses just trying to learn a trade. Be realistic, be conservative with when you first start getting started. You can always scale up and get to the bigger numbers later on. But yes, general idea, 2% is kind of a guideline, right? Once you're up and running, right? You're comfortable with numbers, 2% of your account, or it's $2,000. So $2,000 is our max allowable loss. So let's go back to what I was saying. $3,500, right? This is what we have to put up as margin for a one lot. We're not looking to lose the $3,500. That's what it takes. We know that we can lose up to $2,000 per trade based on this breakdown. The breakdown is a $100,000 account with a max allowable loss of 2% of your net lick. It could be 1%, it could be 5%, it could be whatever you're comfortable with, right? We're just, for this example, we're using 2%. So 2% or $2,000 loss, that's acceptable. Now we're going to say, all right, how many contracts do we do of this iron condor based on these numbers? Well, we know that if we're going to stop out at a loss of $450 per one contract, and our max allowable loss is $2,000, we take 2,000, we divide that by 450, right? We're going to lose a total of $2,000. We know lot one lot has a max potential loss of $450. So we divide 2,000 by 450. That gives us 4.44 contracts. Now we know we cannot do 444 contracts, right? It's either we do 4 or we do 5. The easy math here is if it's over 4.5, you could go to 5. And then again, you want to figure out, okay, what if I do 5? What's 5 times 450? It's 2250. So we're going to be slightly above the 2%. If you're okay with it, fine. If not, then just always round it down. So it's 4 contracts. So now we know that if we lose 450 per contracts and we do four of these contracts, our max allowable loss in this trade, $1,800, which is within the $2,000 allowance that we have based on 2% loss of net lick as our max allowable loss per trade. Right, so four contracts the size, 450 per contracts is the stop loss. So if we get stopped out on four contracts, we're out $1,800. And if we're going to make a profit of about 300 profit times four contracts, we could make about $1,200. So now, how much margin we need? If we're going to put up $3,500 per one contract times four contracts, right? 3,500 times four, that's a $14,000 commitment. That's our margin. And if we're going to make $1,200 profit on $14,000 margin, we take 1,200 divided by 14,000 and we get about 8.5% return on margin. So if we get to 20% in the first 10 days, maybe 15 days, first 2 weeks is reasonable. Might be longer. It all depends. You know, if we catch the market environment where volatility is falling, right? We may get to that profit target a little bit faster. Maybe if the volatility is already relatively low and it's coming out, but just not as great or not as fast, then maybe we'll end up waiting for, you know, 20 days to get to the first target. Right? If you can make 8.5% return on margin in 20 days, I think that is a pretty decent idea as far as trading business go. Right? So these are the profit targets. This is the setup. And this is the actual, you know, the sizing of the trade. And again, if you look around and you say, well, if I take a loss of 450 per contracts times four contracts, right? I'm out $1,800. Man, I don't want to lose $1,800. I'm not willing to lose more than $500. Great. Your contract size is one. Because one contract could lose up to $450. If you're only comfortable risking $500 for any given trade, you know, whether you're just getting started or whatever the case may be, right? Maybe you're not ready to see the kind of losses that exceed $500 per trade, which is totally fine. Then your size is one contract, right? We know what our stop is. And based on our stop, we figure out how many contracts to do. Don't waste your time, you know, looking at, oh, this trade could make me $300. Man, I don't want to make $300. I want to make 3 grand. So I need to do 10 contracts. Okay, great. But you just did math wrong. Because if you do 10 contracts because you want to make $3,000, but you know you're going to lose $450 per one contract, if you smack 10 contracts on, well, if you get to your stop is you're out $4,500. How do you feel about that? Oh, if you didn't think about it, right, before you take the trade, well, this is the most, you know, most retail folks make that same mistake. They think about the profits before they think about the risk. Think about what's on the line for you, right? If you're okay with it, then that's your number. If you are willing to risk more, then you could bump the number of contracts, but it all is based on what's at risk, not based on how much you're going to make. All right, so that's the idea. This is what I have for this trade 3219. I'm going to try to put on these trades. I want to space them. I don't know if they're going to go up every week. We can try to do them every 2 weeks, right? So this way, if we get to, let's say, target one within the first 3 weeks, right? So we'll try to keep two of these trades in rotation. Of course, we can, add more. Obviously, I think that, the more tranches you have going, maybe instead of doing five every other week, you can do two, but do them every week, or, do one twice a week, or whatever the case may be, right? However you want to space them out. I think that if you can layer these trades in over time and over price, the smoother your overall P&L is going to be. Right? So that's another way to do it. I don't know what is the right way to do it. There is no right way. There's what works for you and what doesn't. Right? So figure out what your size is, how you want to sprinkle it around. You want to do it over time, over price, or do you want to do it just in two tranches, every couple of weeks? Whatever works best for you. You can also see that, let's say, in this example we just used, in a $100,000 account, based on the 2% max allowable loss, we get to do four contracts. Four contracts will take up about $14,000, or about 14 or 15% of your overall account. Is that a lot? Ideally, I would not want to exceed maybe 10% allocation for any one given trade, right? Would I go 1.5 times, allocation? Yeah, why not, right? It's an iron Condor in SPX. This is not an earnings play. I think it's okay, but if you write it down and you say, no one single trade can exceed, no one trade can exceed 10% of net lick, then you need to scale it down. Instead of doing four contracts, you should only do three contracts. And doing three contracts, taking a $450 loss, you will not get to your $2,000 planned loss, which is fine, right? You don't have to hit that number. You just want to stay within the the guideline of a max allowable loss and how much are you willing to allocate to any one given trade. Because remember, you spend 14,000 on this trade. If you're going to do another trade 2 weeks later and the first one hasn't come off, now you're at 28,000, right? So you're going to be at almost 30% allocation. It depends, how many trades you want to have at any one given time. Do you want to keep 50% of your cash available at all times? Do you want to, take that number up to 70%? Because these are defined risk trades. So, being super conservative on your overall allocation, keeping it at 50%, maybe a little more conservative than you should be. I'm not saying you should or you shouldn't. I don't know that. I just think that, when you trade naked, strangles, straddles, whatever, you need to have that 50% reserve or more, because when volatility expands, you don't know how much your margin requirement is going to grow. But here we know that this trade could not take up more than $3,500 per one contract, regardless of what volatility is going to do, right? So we can probably go a little bit higher. And then you can say, you know what, if I have 4 contracts on and I have 2 trades going, but the first one hasn't come off yet, it's time for me to put on another one. So maybe I'll have 3 trades with expectations that the first one's going to come off really, really soon, right? You have 14 times three, right? How much do you have already running? So 14,000 times three trades. And I have $42,000 out of 100 that's tied up. And you can say, all right, what happens if I'm holding three trades and the market's going to go limit down or limit up the following day for whatever reason, and I'm forced to take a loss on all three trades? Well, we know that our losses on four contracts are going to be about $1,800. We have three tranches going at the same time, so we are going to take a loss of about $5,500. That sucks, right? But what does that do, or how does that measure against our net lick, right? Worst case scenario, you get stopped out of all three trades. It's very unlikely. I'm not saying it's very unlikely, but it's not very likely that you get stopped out on all trades unless market is doing something like we saw in maybe April of this year or August of last year, right? But these are like, you know, these are really black swan events. So if we're in three tranches here and we hit stops on all three at the same time, we're out $5,500 out of $100,000 account, right? We'll lose 5.5% of your account. Do you think it's reasonable to recover from a 5.5% drawdown? I think it is, right? Maybe there's a slippage and maybe it's not 5.5%, maybe it's 7%. It still stinks. Nobody wants to lose money, but I think that, 7.5% drawdown. And again, for you to get stopped out of all three tranches all at once, something drastic has to happen. It doesn't happen often. And the reason I'm saying this is you always want to know, you want to look at these numbers and understand, right, your worst case scenario. If you hold three tranches and you get stopped out on two, what's your maximum drawdown in your account? If you hold three tranches and you get stepped down on all three, what's your maximum drawdown? And then you have to be comfortable with these numbers at all times. At any given time, if you're not comfortable with that number, right? We just did this number, three tranches, get stepped out all at once, you're out maybe $5,000 or $6,000. If that is an absolutely under no condition acceptable number for you, then three tranches is not the number you should be doing. I don't care how much room you have. If you're not comfortable with that number, do not do the trades. Keep the number of trades down, keep the number of contracts down. As long you do as much as you're comfortable with doing. So that's what I have to say about that. Let me go back and see if there are. I don't think there are many questions. So we'll wrap this up real quick. I'm going to post a recording of this so you guys will get a copy of, and you will hopefully you'll be able to see this on the video as well. I'm going to delete this and then clear all drawings, and then I'm going to close this out. So this is where we are right now. You can see that in one day, the underlying has moved just outside of one standard deviation. Volatility has come down a little bit. Not much is going on. Yes, the market's pushing higher, and that's okay, right? We have puts are losing money. Calls are probably gaining a little bit. They're kind of offsetting one another right now, so that's why our net P&L is relatively flat. Maybe we'll get, in the first couple of weeks, can we get to this 300? If maybe we'll take volatility down a little bit. All right, so maybe we can rally a little bit, volatility falls, and can we get to about $300 profit? Yes, the market can go up 50 points, right, in the next couple of weeks. If volatility comes down a little bit, it's reasonable to expect that we might hit our profit target. Obviously, it's not going to work that way because once we take out 6,400, once again, we're at all-time highs. Everybody's chasing. So I'll be keeping an eye on what happens over 6,400 on SPX. But again, with this trade, if we cross 6,400 to the upside, and a couple of weeks have gone by, even if volatility did not fall, what happens at 6,400? We're at a profit of about $150. So we're not quite at 20% of max profit, we're at 10%. If you fear that the market's going to really go into this mother of all squeeze modes, right? Then you don't hit price target one or profit target one, and you walk away with, only 10% of max profit and reset the trade. It's your trade. You can do whatever you want with it, right? Maybe we run up to 6,400, maybe we get to 6,500, and then on any kind of pullback, right? Again, this trade is going to come into play. The biggest risk is if we break above 6,400 and the market is moving, one standard deviation back to back to back couple of days. Obviously, the market is chasing, shorts are getting squeezed. You kind of don't want to let it run too far. You hit 450 drawdown, which is going to be right around 65.40 or so. Get out of this trade, get out of the way. Don't argue with the market. The market's always right. We're all always wrong. Don't try to change that. Have a plan, follow your plan, honor your plan, and you'll be in good shape in the long run. K Fall says, would you recommend this trade in an IRA? You can absolutely do this trade in an IRA as long as your IRA account allows you to do spreads. Right? For spreads, you need to have, I believe it's level 2, margin approval. If your IRA allows you to do spreads, then yes, this is a defined risk trade. There's really nothing wrong with it. As long as, again, with IRAs, I always say that, IRAs, everybody wants to trade IRAs and it's a great thing. But here's something to think about when it comes to IRAs, guys. Your IRAs, right? You can, and again, this is not a financial advice, so don't, you want to grow this account over many, many years, right? So do you want to get super aggressive with some kind of strategies where it could, generate 40, 50, 60% return year one, year two? But again, if you're looking to make 40, 50% profits, understand that, you're probably putting yourself in the position where you can face a 40, 50% drawdown should something go against you, right? In an IRA, you can only put in and a certain amount of dollars into your retirement account, right? For example, if you lose 60% of your individual account and it's your trading account, right? You can replenish this. If you lose a big chunk of that money in your IRA account, you cannot replenish because you only could put in so much money per year into your retirement account. So don't treat your IRAs as your, trading accounts. Yes, you can try to, use a portion of your IRA account to maybe boost your long-term profits in your retirement accounts, but just be careful with when it comes to IRAs. I know that people want to retire early and all that stuff. I get it, but just keep in mind that with IRAs you could only contribute so much per year, that if something bad goes on, you cannot replenish, and it could put you in a really bad position. Time Merchant says 20% of credit is very reasonable, equals to 8.5% of margin. This is the math we just did. I typically use 7% of max loss as a profit target, which is totally fine. This equates to about 16% of credit. I use these profit targets for most of my iron condors, broken wing butterflies, and so on. I think those are great. Numbers are, again, we're not shooting for, let me capture 80% of max profit. You have to be there forever, right? And the longer you stay in the trade, the longer you expose yourself to something possibly going against you. If you can grab the first 7%, 10%, 20%, whatever it may be, you will just have more trades, right? You will be trading more often. You want to keep these trades down in size if you're going to trade more often. Again, if you sprinkle your trades over price and over time, right? The more trades you have on, the smoother your P&L graph is going to look. Yes, you may have a couple of, losers back to back to back, but then you can go on, stretch of winners back to back to back. And I think winners will outpace losers in the long run. You just have to stay consistent, and remember, consistent input will result in consistent output. So hopefully I gave you something to think about. If you are following along, this is a trade 3219. We also have a couple of other iron condors that just came off recently. Whatever, I didn't make any adjustments. I don't really plan on making any adjustments here. It's kind of either we hit profit target or stop loss and get out. But I'm collecting data for these kind of 50 wides for $15. I may do a few other variations as well. Collect enough data so that we can say, all right, on average, over the last 100 trades, we were able to hit X amount of profit in so many days and so on. So we actually have some hard data, not just some hypothetical back tests. And going forward, I think that information is going to help us deploy capital more efficiently, and I hope this is going to help everybody. All right, I'm going to run, guys. If you have any questions, you can find me on Discord. Until next time, trade and well, and we'll be back on Friday. Take care, everybody. Bye bye.